Hello, everybody, and welcome to our class. Today, we're going to talk about the Greeks. Kalimera, everyone. If you know, this is hello in Greek. And today, we're going to see what are some of these words mean in options. And we'll see how important they are for us when we are building strategies in options. And we want to look deep inside and see how our strategy is going. If it's pretty flat, or maybe it's different, maybe it's difficult, or maybe it's dangerous. And we'll see how those Greek letters can help us see and measure our positions. So let's start with the general definition. The Greeks are a measure designed to better understand how options price change when the underlying stock changes in value and or in time passes by. And you do remember that options decline in value through time. The Greeks are a vital tool in risk management. Each Greek measures the sensitivity of the value of a portfolio to a small change in a given underlying parameter. The Greeks in the Black-Scholes model are relatively easy to calculate, a desirable property of financial models, and are very useful for a derivative trader, especially those who seek to hedge their portfolios. In other words, it really helps you to see better what's going inside your option strategy. Okay, now remember that we talked that options have prices, but sometimes they vary because we don't always know how much an option costs. So that's why we have this theoretical model called Black-Scholes model, and it helps us to understand relatively how it works. One of the parameters inside this model, Black-Scholes, has this letter called delta. You see, delta is the amount the option will change in value if the stock goes up by $1 exactly. If an option carries a delta of 70, let's say, and the stock goes up by $1, the price of the option will rise by 0.7. That means $70 because the multiplier is 100. Okay, now owning an option which has a delta of 70 means that you owe the equivalent of 70 shares of the company's stock. That means you're not 100 delta, you're only 70% delta, and that means that you own maybe 70% of the stock. So that means that if the stock will go by $1, the call option will rise only 0.7 and not one whole dollar. We'll see this example a little bit later. All options do not have the same delta value. Deep in the money options have very high delta value, perhaps in the 90s, and I go with the 100s, while way out of the money options have very low delta values, and it could really go below 100, below 10. You can calculate the net delta value of your composite option position by multiplying the delta value of your long position by the number of those options and subtracting the delta value of your short options multiplied by the number of those options. The resulting figure, you get a net delta value, tells you how much the value of your current option portfolio will change if the underlying stock goes up by $1. It is perhaps the best measure of market risk at any given moment. Okay, enough with definitions. Let's go and see what it's all about for real. We're going to see now the Apple share, which is currently traded at around $125. And in this example, you can see the graph of the underlying asset, the stock, the Apple stock, and you can see that here we have what is called delta, and the delta is 100. That means that it goes plus 100 if we buy the underlying, if we buy the stock, then that means that every movement equals to $1 equals to 100. So then, as you can see, that if the stock will rise from 125 to 135, we're going to generate $1,000 profit. Okay, so then that means that we have here, when we buy an asset, we have a delta of 100. On the other hand, if we're selling it, going short on this stock, then you can see that the delta has changed to minus 100. That means we're going negative, we're going short, and that means that when we have a negative delta and the market goes down, then you're going to generate a profit because your delta is negative. Okay, so this is how delta 100 works. Now let's see how it works in options. So here we have the option chain of Apple, which has a 29-day till expiry. And you can see here that right here in the middle, 125, this is our middle point. And you can see the value, the bid and the ask values that is running right now. Currently, again, the stock is at 125. And the interesting thing I want to show you is that here the delta is nearly all but more than 0.5. And that means that 0.5 in delta, that means that the stock is exactly at the strike price right now. That means that whenever the stock will rise up and we bought the call option, that means that this call option will enter the money, and that's why and the market is starting. And that's why the delta is going to rise until it's going to reach the level of 100. And 100 delta means that it goes one by the market. It acts just like you bought the whole stock. Okay, so now you see you see call 90 or call 100 on Apple is pretty deep in the money. So you can see that delta here is almost 0.9. Now through time, this option will get a greater delta. The delta will rise because the underlying is entering the money. And you see here, when we have almost 1 day till expiration, the delta here is already 90, but all those options are pretty much inside the money, deep in the money. And that's why the delta is way above 50, closer to 100. The deeper you go, the higher the delta goes. Now, on the other hand, if you're going upwards and looking at the out of the money options, call options, then you can see that the delta is declining. That means that if you're looking here at Apple stock at 140, the delta is 0.06. It is so out of the money. And even if the Apple stock will rise by $1, it still won't make any big difference. It has a significant way to go up until the stock will reach the money or near the money, and only then when the delta will rise up. So out of the money, very low delta. Let's see that now on the graph. Let's say we bought the call 125. Excuse me. And you can see here that you see here we have those price slices. Excuse me again. And you can see that at this point, at 125, which is the current stock price, you can see the delta is nearly exactly 50. And when the market will rise up to 150, let's say, the delta will be exactly 100. Otherwise, if it goes out of the money, the delta will decline. And that's it. That's all you need to know about delta. Market goes up, delta goes up if you buy the call option. It goes the same if you go short with the puts. Let's see. Let's see the example. Let's say we're buying a put option, but let's buy someone who's in the money. Put 135 put, as you can see here. The delta is 100. So if we're gonna buy, and we're gonna buy just one, now we're gonna see our risk profile. Yep, that's it. You can see that the delta is again minus almost 100, 99.96. That's not bad. But as you can see, it stays there until it reaches out of the money, and then the delta will be zero. It's exactly the same as if we've sold only the stock. And you can see that also the delta will be minus 100. So this is basically how you calculate your deltas. If you go long or short, the delta will show it to you. Now, let's see something also interesting. Let's say we bought the stock, okay, and we've added also, we purchased another call on the strike and 125, and we paid for it $3.30. So see now the delta has changed. You see, because we bought the stock and the call option on the same stock on the strike, and then we got an additional 50 deltas to our calculation. And once the stock will rise, hopefully, and enter the money, or really enter into deep into the money, the delta will also rise until we're going to make it to 200. And that means that you're equivalent exactly as if you bought two underlying stock stocks, not options. So you have 100 delta from the stock and 100 delta from the option that you have bought. Now, keep in mind that if the underlying will go down, then your delta will eventually, of course, if you bought this call at 125 and it went out of the money, then your combined position holding the stock and the option will be reduced to 100. Okay. And that's it. This is how you calculate. Now, let's say, let's make it more fun. And let's say that we have bought also the put option. That's really annoying. Geez. Okay, now, as you can see, we bought also one put option also, but this one is really deep in the money as a 135. Then you can see that this whole combination now, we don't hold exactly 100 delta anymore, because when we bought the put option, remember, it gave us a minus delta, and it really reduced this whole calculation of our entire portfolio. Now, in this portfolio, we're holding again, we bought one stock, we bought one call, it's 125, and we bought one deep in the money put, and all this combined together will bring us again to delta 50. If the market will rise up, then you can see that we're going to have a delta of 90, and then eventually delta of 200. But if it falls to 100, we're going to get a neutral. We're going to get a zero. That's because, quick recap. Remember, when you're buying the stock, you have a delta of 100, and you buy a put, it gives you protection. So then that means that you cannot lose more than this put hedging. So that's why it reduced our delta, and our losses are also reduced significantly, because in this, if you're going to trade this position, then you can maximum lose a little bit less than $400. Without the buy of the put, then you can see our delta not good, will go down. So delta is really good for you to see where you're standing and how your portfolio will change when the underlying asset will move up or down $1. Okay, so let's move to the other one.